All right, Sunil Subramaniam joins us now. I must say that Sunil has been consistently bullish on the market. I mean, I've had my moments of both, hot and cold, where the medical crisis, in a sense, has forced me to get slightly cautious about the economy. But Sunil has been like the real Parma bull. Okay, Sunil, in the limited experience I have never seen a market where there is a complete disregard to the present and a complete endorsement of about future, which is that everybody is ignoring what is happening to the economy on the medical front, on the demand front, but there is a strong faith that tomorrow will be better than today and day after will be better than tomorrow. Is it a good strategy to be optimistic when the present is so shaky?
Absolutely. The key, Nikonj, is the availability of liquidity. All the theories, fundamentals, everything, ultimately the bedrock is that there has to be liquidity to actuate what you expect, right? If liquidity is dry, the best good news cannot deliver you the results because there's nobody as a buyer. So today the situation is in a sea awash with liquidity, right? You are looking for a reason. And the second thing with liquidity, Nikonj, is that liquidity is like the sea. There are short-term waves hitting against the sand of the beach, and there are long-term trends, right? So similarly, in this liquidity, there is the long-term pension fund, sovereign wealth fund, who's looking at the longer term, and there is a short-term hedge fund who's leveraging of the interest rate scenario. So the situation when it comes out that in this availability of liquidity, the key is the bad economic general news overseas, not that it's going to improve, but the overall situation of one-off trying to revive an economy. So as long as that situation prevails, I think that optimism has to be the way forward, because even those who were not optimists, who were pessimists or realists, I think the last 1 year of the COVID crisis and the market reaction has taught them, I wouldn't say call them a lesson, but it's it has burnt them a little bit, that their view that a COVID crisis lockdown would lead to a deep bear market, and they got hammered out of it. So I think that this liquidity is the key, and any future direction, the optimism or the realism, though you call me an eternal optimist, the fact is there's an underlying thing that I don't see the liquidity tap running dry until the US shows very strong growth, very strong employment generation, and very strong inflation forecast. These three things, if you look at it, is the one which will cause us to temper the optimism, because the stock markets are a function of that, plus the good expected news on the domestic front. You pointed out that the current news is not so good, right? With the second wave and the impact with localized lockdowns happening. But the key point, Nikonj, I would say is that why is that money still coming to India? After 2 months where the FIIs were a little bit shaky about the fact that there's a commodity revival, so should they shift their money to other commodities? India doesn't seem to have managed the second wave or anticipated it. And it seems the media news was so bad about India that they took a breather. But this month you're seeing again that has come back. Because what are you seeing? You're seeing that ultimately the second wave is beginning to peak. The vaccination, the old ideas of the government that I am the vaccine annadata, I give to other countries, that's reversed. You stopped exporting. You've opened up the doors to Sputnik. You've opened up the doors to the other ones like Moderna and maybe Johnson coming on the way. And I think there's a reasonable expectation that within this calendar, or latest by the fiscal year, you will have 70-75% of the Indian population vaccinated at least one time. So when that's the situation, people are then looking beyond that period. And you mentioned, I think that not all the stocks are rising. Why? Because what they're looking at is the market is dealing in surprises. Where do they expect a positive surprise in a stock, and where do they expect a negative surprise? Forget about this quarter's result. Is this a sustainable? If a bank is showing higher NPAs, is that sustainable, or is that a one-time that they are absorbing and doing it? So I think these are the factors at play, Nikunj. So overall, I retain my sense of optimism. Just I'm keeping my eye on the global scenario. Domestically, I'm not so worried. I believe that we are again in a shape where this downtrend of this quarter's results will reflect the series of lockdowns, and you will see that uptick will happen by Diwali. So I'm confident that domestic numbers will improve in a matter of months. monsoon forecast is good, which is good sign for rural demand as far as for agriculture related inputs. Domestically, I wouldn't say there is so much cause for worry. It's an international scenario, and there, very paradoxically, the return of growth will not be good news for our markets. That's where again you will come to me, Nikunj, in a few months and say, Sunil, why is this market again ignoring the good economic story of India, but is not rising as fast as it was 3-4 months ago? But that's what we got to be prepared. The question is when? When is the real advanced countries going to get into a full-fledged recovery mode? I don't see that happening so quickly, but it is a matter of time.
Okay. Sunil, okay, I'm just being the devil's advocate here, and I want to be a contra. I want to throw in a contra question. Now, this is not my view. This is not the channel view, but I just want to bring out this important aspect.
Sure.
Based on the first wave, everybody is optimistic that the same playbook would be at play, which is then when economy will normalize, and it has already normalized in some parts of India, the demand is going to surprise us. But the difference, Sunil, is that markets are at a record high. We are not at a level of 8,000 or 9,000 on the Nifty, we are on 15,000 on the Nifty. So while the playbook may pan out, economy will revive, demand will come back, demand may surprise, aren't stock markets pricing that in?
The stock markets are definitely, here I agree with you, Nikunj, that the current valuation of the stock markets prices in a very strong recovery. The key is that it's not equally priced across sectors. Certain sectors have taken the lead and are way overvalued, and certain sectors are in fact still undervalued. I would say in terms of the cyclicals and all of that. So I would say that while the overall market looks to be reasonably or slightly rich in valuation, right, there are definitely pockets. And what you will see is a redistribution of the flows from one sector to another. So the overall Nifty may not rise very much, but there's still opportunity to make very good returns if you choose the right kind of sectors and stocks. So that's number one. Number two is that market is the weighted average prediction of a certain earnings, right? Still, there are surprises possible because sometimes bounce backs. People say, okay, 50% rise I expect in this, but that could surprise you with a 75 or 100% because you're sitting now, you feel 50%, you're doing great, boom prediction. But markets have surprised us, right? So you could have stocks and sectors which are delivering way above even those rich expectations because the revival is so strong. It's possible for the market to correctly predict, that is every participant to predict. So there are always a bunch of pessimists, optimists, realists putting their money together. And what is reflected is the weighted average expectations of those people. And so I would still say that there is still potential for surprises, both upsides and downsides, which if the upside surprises are higher, could take the market to even higher levels, number one. Number two is that 1 year from now, right, what is the market going to see? Not that quarter's earnings. It's going to see 1 year from then on what the future outlook is. So market is trading in a series of forward Ps, Nikunj. So the point is today you say, oh, I'm predicting, let's say 28 PE, okay? And when that time arrives, that 28 may not have arrived, which is your point, right? That the market is already pricing, there could be negative surprise. But if at that stage, there is news that in a year from now, India is going to be very strong, then I don't see a problem for the market to predict a 32 PE then. And you will say, oh, the earnings expected didn't deliver, still market is higher because market trades on a series of forward expectations. The market is always forward looking, future looking, and it's that which is important for us. The optimism around India as a growth country, right, has to be retained, then the markets can be higher too.
Yeah, get your point, Sunil, well elaborated. But if we were to just look at the broader markets, the Sundaram Mid-Cap Fund, for instance, in a one-year basis has outperformed some of the others like the equity hybrid or diversified equity, 67% returns. And looking at the kind of recent buys as well, SRF, IPCA, Page, what are you advising when it comes to opportunity within the broader markets?
I think that two things have happened. If I take the market broadly as large cap, mid cap, small cap, the large caps have risen on the back of two things, right? Two very different things. One is FII flows, which are largely in the large cap segment, but within that, driven by a safety-oriented sectoral uptick, right? So healthcare, pharma, IT, some amount of banks, right? That's where the large cap index has reached what we are. At the other end of the barbell is the small cap index, which, though it is heavily loaded with industrials, has risen as much as the large caps, or even better, to the extent that the forward P of the small cap index today equals the large cap index because of liquidity, lack of liquidity in the stocks. There is some money flowing into that, not from the FIIs, but from domestic MFs, Robinhood investors, general market people, right? There, what has happened is the fact that the free float is very less. Promoters and institutions own 50, 60, 65% of these small size stocks. So the very tight liquidity situation of the stocks available for sale or purchase means that even a small reaction, somebody wanting to buy a block deal, can shoot up the stock prices. So the small cap has been the beneficiary of that, and hence small cap has risen to the fact that the forward PE is equal to the large cap. Now, what has happened is that's the polarization, because the polarization is a very strong industrial kind of a sector. Now, mid caps are in between. Even today, despite all of this, because mid caps are far more diversified, because they have the ability to absorb the liquidity coming in, whether it's some amount of FII liquidity, some amount of domestic investor liquidity, they're able to absorb it over a wider space, and hence the mid-cap forward PE is today at a 30% discount to the large cap and the small cap.
Sure.
So like you said, the mid-cap is in a sweet spot because there's an ability to absorb it across a wide range, and leadership could shift very easily. So I would say that's the best bet for the way forward. In the next 2 to 3 years, I would expect the mid-cap index to outperform both the other two extreme indices.
Sunil, a bit short on time, but we want to get in a view from you. What's the mantra to get rich, the secret sauce?
The secret sauce to get rich is to set a goal, set an ambitious goal, and to liquidate when your goal is reached. So let us say very simply, I would say, regardless of whatever anybody does, keep 3x as your goal. You want to get rich, you buy a stock, you buy a mutual fund, whatever. You say that if it multiplies 3 times, I will ruthlessly exit and then look at a fresh investment. So I think 3x is a very reasonable, because you know the rule of 72 for doubling, right? So if you want an 18% return, it doubles in 4 years. So if it's gone 3 times, you can say the return is going to be far, far higher, right? So I would say simple mantra, keep 3x as your goal. I'm very simplifying it, but I'm saying the point is people don't know when to exit in the wealth creation journey. They know they can see the paper wealth rising, but sadly, they see it also falling because they didn't pull out. So the secret to wealth creation is knowing when to sell. And a simple rule of multiplying your investment 3 times, right? I think it's a simple way where you'll consistently make money and create wealth for yourself.